let's start with the history of Bitcoin. So firstly, as you might remember, I'm assuming everyone in the call is old enough to remember that 2008 we had a Lehman crisis. Lehman Brothers, the largest bankruptcy on the planet till date, corporate bankruptcy of $653 billion. I used to work there in London, but at Lehman, and though I don't want to take any credit for what happened, but there's lots of learning. But essentially what happened was that led some people to think that, shall we think of finance in a new way? Should we think of finance in a different way? Why do we need a centralized bank, centralized institution, centralized central banks, financial institutions, centralized regulators, where a handful of people make most of the decisions? You know, whether it's the central bank governor, whether it's a finance minister, whether it's a CEO of a bank like Dick Fuld, Richard Fuld of Lehman Brothers, etc. And many times those decisions go wrong. So centralization has a problem. You know, like in your firm, you have your structure that I don't pretend to know well, but clearly there must be some hierarchy and there's somebody at the top. Now that person, as long as making good decisions, it works well. You know, then you have the partners network, you act like a community, you all think after each other, for everyone, it impacts you and everything else. That's a decentralized model. And the moment you start engaging everyone in a decentralized model, it becomes more of a community thing. And that's what people started thinking. Why can't we have finance work like that? Why do we need a bank in between bringing a borrower and lender together? And especially when the banks clearly failed, right? They clearly failed in with reckless leverage and all the risks that they took, etc. And in after the 15 September 2008 Lehman's filing of bankruptcy, some people unknown till date with an alias of Satoshi Nakamoto came up with a white paper, which they put online somewhere, and said that let's have a decentralized payment system. Let's have a digital global virtual currency. It should be called Bitcoin. It should be borderless. It should just act like internet. Like internet is meant to be borderless. Now we are, of course, regulating it, splitting it. There's a lot of splinter net happening, but keeping that apart, they felt that let's have a decentralized system where you and I can financially transact. I can make payment to you. You can make payment to me in return for any product or service without necessarily having a trusted intermediary. Why can't we build the trust in a decentralized fashion, where you and I do not go through an HDFC bank in the middle or Lehman Brothers in the middle, but you and I just transact. We make payments to each other, and the trust will be built by a decentralized mechanism, a community platform, a protocol, which is actually essentially the blockchain technology, which I'll explain in a bit. And this would be a global currency. This will be a digital currency. This will be a virtual currency. This will be an anonymous currency. So when I'm transacting on internet, nobody needs to know who I am. They don't need to know my name as Kunal. They may know me as my online alias or my online digital address, my wallet address as ABC123, whatever the number may look like, right? So that was the intent. That's the backdrop of Bitcoin as a currency's beginning, right? November 2008, they came up with a white paper. In 2009, they developed the technology. Open source guys got involved. They are fairly smart. And if you remember, or if you've heard that Linux, as an example, was trying to compete with Microsoft, and they were just open source guys. You know, people who just want to do good, hackers, smart programmers who just got together, built thousands of, eventually crowdsourced the whole platform to beat Microsoft till date. You know, Linux is their biggest competitor if you talk about Microsoft's operating system. And they are way more stable and secure than Microsoft, because Microsoft can only hire 10,000, 50,000, 100,000 employees. But these open source guys have millions of contributors, right? And if you crowdsource it well, this can work. So crowdsourcing has worked in the past, you know, so that's where Bitcoin came in as well. It was completely community-driven platform, community-developed source code program, community-driven, community-led, community-fed, community-used, community-invested, etc. So that was the whole idea, crowdsource as a big term. Now, before I get into how Bitcoin started getting adoption and everything, maybe it's time to address what is blockchain. Say I am Satoshi Nakamoto. I say we are starting Bitcoin today. Firstly, before I do that, let me ask a question. You remember in 2008, internet existed, PayPal existed, digital messaging existed, right? All those things were already prevalent. We are not talking 1980s or 90s. Ask yourself, if you haven't asked this before, why did they need to invent a new technology like blockchain to deliver Bitcoin? Essentially, Bitcoin is a financial transfer message, or it's an internet-based technology message on top of internet layer where you just send money to someone, right? I'll answer this for you, but ask, why do we need a new technology? Already PayPal was sending money somehow. Already emails were happening, text messages were going. Why could not money go the same way? Why did we need a new technology? So just ask yourself, so you become curious and understand why blockchain was invented. I'll give you the answer. Internet has a problem that on internet everything is a copy. It's called the double spend problem. If I forward a message to you, it's never the original and never only one. When I send it to you, you send it to 100 people. It's a copy, right? An email, a message, a photograph, a scan copy of a note, or anything, right? That's a problem with money because people don't value things which are unlimited in supply. If you had suddenly, people copying notes and forwarding notes and them being treated as unique real money, it would not work. So they wanted to uniquely be able to send someone something. Hence, they had to develop something like a blockchain technology, which I'll describe shortly. Okay, that's it, to address the double spend problem. Now, let me explain. Imagine I am Satoshi Nakamoto. This is moment zero, T0, moment zero, which is November or 2009 or 8 or whatever time, whenever it started, day one. I say for Bitcoin to be valuable, we should limit its supply. So I say, let's say I'm picking a number, which is a real number. I say there are going to be only 21 million Bitcoins ever, not more than that ever. Out of that, moment zero, I'm allocating 1 million to me, myself, for the sake of it. I'm starting the world, 1 million to me. 20 million I'm keeping apart aside. We'll talk about it later where it goes, okay? I'm explaining the blockchain technology behind Bitcoin, okay? Moment one. And on internet, I am not Kunal Nandwani. I am an anonymous address, which is a computer digital wallet address on blockchain, which is a 29-letter alphanumeric address. I might be ABC11100XYZ, whatever I am. For the sake of simplicity, call me A. Okay, I'm A. Moment one. Moment zero, I have 1 million and 20 million we've kept apart. Moment one, A gives money to B. That's moment one. Imagine all of you, the rest, how many people are in the group? 41 people, I believe, 42. All 42 of you in the group are the blockchain and Bitcoin community. Your job is to validate this transaction. So what will you do when you have to validate the transaction? All of you will do the following. All of you will check when A has given money to B. Did he have the money before? Yes, I had 1 million from moment zero. Now I've given him a Bitcoin. I have now 1 million minus one, and he has a Bitcoin. Check. Fine. Now imagine all of you have to digitally stamp it. Let me explain the stamping process. Do you remember in the older days, you might have seen Game of Thrones or stories of kings and all, thousands of hundreds of years ago. People used to, how did, when a king sent a message to his soldiers or his generals in different parts of the world or country, through riders or ravens or through whatever pigeons and all, how did those guys know that this is a real message coming from the king? They had a unique stamp, right? Now, fast forward the clock, today, 2008, 12 years ago, 13 years ago. Now it's a digital world. Now we have digital stamps, which are time varying. Assume there is a stamp you can do, stamping process, which is just meant to be unique for that moment, okay? Essentially, when A has given money to B, you check that, then all of you now have to come up with a digital time varying stamp. I'll tell you what it is. It's essentially a cryptographically generated number, which is random and it changes all the time. So think of it like, have you seen movies in which they open the lockers? How do they open a locker of a big bank or vault that they're trying to open? They will, just move the dial, tuck, 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 and it clicks. You just have to try. There's no fixed number. There's no fixed algorithm. You just have to keep trying. And imagine now that dial is constantly changing and it will click somewhere else. All of you have to now guess another 30-letter alphanumeric character, which is a digital timestamp, which is actually a maths problem that you solve. And then it's only way you do it is by guessing. There is no fixed formula. You can't apply a fixed formula and always come up with a better, faster answer. You all have to keep trying. And let's say one person comes up with the hash. That's called a hash or a digital timestamp. You announce to the rest of the group, just like you do in Tambola or Bingo, you say, I got it. I got the hash. Rest of you, 41 out of the 42, now 51% of you have to double check it's a right hash. It's a right stamp. It's a right stamp. You say, yes, we got it. Moment one is complete. That transaction is sealed. You move on to moment number two. Moment zero, I had 1 million, 20 million was somewhere else. Moment one, I had 1 million minus one. Sid got 1 Bitcoin, and you stamped that transaction, and you froze that transaction and block. Moment two, now Sid has a Bitcoin. Let's say he gives half a Bitcoin to one of the team members in return for some product or service. Moment two, I give another Bitcoin to one of you in exchange for any product or service. All of you get to the work again. 42 of you, you come up with the hash. Whoever comes up with the hash first, after validating that these are valid transactions, raise your hand, announce to the group, and say, I got it. And 51% people have to agree again. When you agree, this is the right hash, you move on. That is moment two, time stamped. A gives money to C, B gives money to D. And this is how the world evolves. It keeps evolving, and more people are added to the blockchain wallet addresses and all. This concept of putting a block of transactions every moment in a chain is called blockchain. You all have equal probability of coming up with the number, and probabilistically driven, all of you have equal chance, or one divide by whatever the number mathematically, whatever chance you have, you will come up with a hash. Now you may ask, what's the incentive for me to do this? The incentive is, remember, I kept 20 million Bitcoins on. Imagine I say 1 Bitcoin to everyone who comes up with every hash every moment. That is your incentive to do this process. And that incentive is the process called mining. Mining is the process in which you validate transactions, come up with a hash, you do it luckily and faster than others, and you get paid in Bitcoin itself. This is the concept of blockchain mining, and this is the concept of blockchain. All of you are basically, you are all running the same blockchain open source software. All of you are getting the transactions from internet. A gives money to B, B gives money to C, C gives money to D. In every block, you can have a few dozens to hundreds to thousands of transactions. And every block can be mined every 7 seconds or 1 minute or 5 minutes. You can define it however you want. However, the blockchain consensus protocol, the community decides. And your incentive of doing this is that you get paid coins. Now, see how beautiful the concept is. You are accepting a currency, all of us in the world, let's say 42 of us. You are using, and then now all of you are holding Bitcoins. You are mining Bitcoins, and then you are spending the same currency to get in exchange for some product or service with each other. And as the world starts adopting it, then it becomes bigger and bigger. And this is a completely decentralized process. It's not dependent on one guy or 10 guys or 20 guys or one country or another country. It's on internet, it's global, it's borderless. These miners could be sitting in China, in Iceland, in US, in India, anywhere, as long as, of course, they're complying with the local rules, etc. This concept is called blockchain, which is essentially a chain of transactions put together in a block every few moments, and then sealed, stamped with a cryptographically generated number, which majority of us and majority of the mining community agrees on. Mining community is typically person like me. I may have a server mine. I may have a farm data center where I have thousands of servers. More servers are deployed, higher is my probability of coming up with this hash first and getting paid in Bitcoin itself. And then if Bitcoin value keeps going up, I keep benefiting from it, right? So this is the concept of blockchain. I hope it makes sense. This is the simplest way I can explain it. This is one of the protocols. Over time, many firms have come up with their own protocol. They said, why do you need 51%? Why can't you do 10%? 10% of majority is good enough. Or some people say that, let's say one miner, one guy who has hundreds of Bitcoins, if he says it's a right transaction, then we accept it because he has more to lose. He's it's like more credible person in the team. In the board meetings, you have one guy with 5 votes or 2 votes or 10 votes. Like Facebook, Zuckerberg has, I don't know how many votes. He has all the votes. Nobody else counts, right? So you give more votes to some people. That's called the concept of staking. You have a bigger stake in the game. Your value is higher. Your opinion is higher in the mining or blockchain process. So you can make many variations to the game. This is what all the blockchains are coming. IBM has launched their own, banks have launched their own, everyone has launched their own, right? The challenge, one of the challenges here I want to briefly mention, and then I'll open to the question, is that for one transaction or 10 transactions or 100 transactions, a centralized process would have meant one guy, one system, one Paytm, one PayPal, one bank is checking all that. Now there are thousands and hundreds of thousands of servers checking all transactions. This is highly energy inefficient. This is just like decentralization comes at a cost. It makes things slower and it makes things inefficient. So today, if I buy a Starbucks coffee with a Bitcoin, or I buy a Tesla car in US with a Bitcoin, that transaction will be looked upon anonymously. A is buying from B. A, B could be anyone. A could be me. B could be Tesla company, as an example. That would be checked, validated by hundreds of thousands of servers around the world. And that's producing lots of electricity, wasting lots of electricity, which could even run a whole country like Austria and Germany. Okay, that's the inefficient part, which I'll get towards later as well. I hope it makes sense. Bitcoin history, why it started, and blockchain as a technology. Open to question. There was somebody who raised hand. I'll take a question if that is okay. So there is no fixed number. It's a software. It's just, think of it like, do you have any program or any application where you can say, find a random number? So random itself is, in computing, is a formula or a function or a class, which says, you say random. In Excel, there is a formula. You can put in random and it'll give a random number. Now, so somebody has defined random behind that. Random could be anything from 1 to 100, 1 to million, 1 to billion, or whatever, right? Or alphanumeric 30 character. So, when I said that in 2008, somebody published a paper, and then 2009, some smart programmers, ethical hackers developed the open source software. That is the underlying blockchain software, where they defined what would a node be, what would a server be, how would they communicate, what would be the TCP/IP protocol, however they will communicate and exchange messages, and how will this hash cryptographically change all the time at all. It's a dynamically changing number. So they put in some functions behind, which now governs and is validated by everyone, and everyone is happy that yes, it's a fairly random number. That random, consider it as for the sake of simplicity, that it's just a random number generation formula. Okay, at the heart of it. But of course, it's actually a cryptographically generated number. So you have to solve a maths problem, which is a cryptographic problem solving that your server will do behind the scenes. But essentially, it's at the end, an outcome is a random number, alphanumeric X characters.
Right. Thank you.
Okay. So let me explain a little further, given you've asked this question. So imagine Duo Associates accepts Bitcoin, and I become your client, and I pay you Bitcoin in return for some of your consulting and services and whatever. You know, when I will pay you that Bitcoin, or fraction of a Bitcoin, it runs up to 10th decimal. So I can give you 0.00000001 Bitcoin for whatever its value might look like today, $10 or 10 rupees or whatever it may look like, right? When I send you that, unfortunate part is, we are in June 2021. They will see where I got it from. It was a previous block. Where they got it from, it was a previous block. They actually go back to the 2009 since the first block. That's how they validate. And imagine how inefficient it is. That's where the banks' end of day systems are great. They say end of day, this is a ledger. You have X, I have Y. I am credit X, debit Y, whatever it is. But end of day, they don't go back and check 1,000 years ago or 100 years ago, 10 years ago, what was the balance, where it came from. They trust their centralized end of day process. Blockchain, they don't. That's again another inefficiency in Bitcoin, FYI. So, just wanted to add that to your question, and maybe it will help you visualize how inefficient every transaction is today. So the assumption is, let's say in your firm, I don't know how many partners you have. Say you have 100 partners, right? Or 10 partners. If 6 of you, and let's say the protocol or your consensus protocol says that if majority agrees on something, it's fine, right? Now, if 6 of you agree and start doing the wrong things, and 6 might be connected with one guy, or maybe all 6 are evil, let's say, that's a problem, because then the community play doesn't work. You've influenced of 51% people. This is a problem with democracy as well, that if you influence a few people, it's the same problem here as well, that what if today, for example, one of the fears people have is that 80% mining is happening in China. The reason it's happening in China is the temperatures are cold and the government gives free electricity. So their cost of mining is lower and their incentive for generating Bitcoin is faster and higher. Now, 80% mining is happening in China. People feel, what if all 51% of them agree on one side? They can change and alter all the transactions. They can agree, disagree, and do some manipulative things. That's a risk. That's a risk that, yes, 51% people get together. They can, they can cause problems to the trusted decentralized system. Yeah. So that's a challenge we live with. There's no gold-based value. One can argue.
There is no intrinsic value. Gold
There's
based
no,
or
yeah, there's no
I mean,
intrinsic.
there's
I mean,
nothing backing it finally.
correct. You're right. But again, the Bitcoiners or the people who are pro Bitcoin will tell you that, why do you believe in gold? It's a yellow rock metal at the end of the day. Is its intrinsic value really real or not? You can always debate on it, what's the value and what's not. It's a genuine concern that it's not intrinsic. It doesn't have its intrinsic value is actually whatever we believe it to be.
That's what
And eventually what the market decides. Today we say it's 40,000, tomorrow we say it's 30,000. So my view is the following. When we say the community is now today comprised of maybe thousands to hundreds of thousands of people who have Bitcoin wallets, or maybe now uh, lakhs and crores of them today, because many Indians have invested. They're part of the community. They have an address. They can choose to mine. They transact with the money, or they invest in it, or trade with it, right? So that's a part of the community. Community is not the same thing. If, for example, community doesn't decide together at all. Everyone has a right to their different opinions, and everyone thinks differently. I may, it's just like share market. In share markets, when somebody is buying a share on the same news, somebody else is selling as well, right? So it's a belief that you have in it or not. And then eventually, of course, some bigger transactions and some bigger influencers who've in turn become manipulators, like Elon Musk as an example, actually drive the sentiment. And it's highly retail, emotionally, trust-based driven. Today, I might have, if I bought Bitcoin at 5,000 and today, let's say it's at 40,000. If it drops 10, 20%, I may be able to hold. That's me. You may say, it's dropping. I was expecting 40. Now it's 35. I'm going to sell. Somebody else might say, as long as I'm positive from 5,000 plus, I'll keep holding. And they call it hold on to dear life. I'll hold it as long as it's higher than the value at which I bought it. I'll not sell. Let me briefly talk about a quick evolution of Bitcoin and blockchain in the last 10 years. So firstly, you understand 2009, we developed the software, how the software works. That's the open source blockchain software. And now there were no adopters initially. So Satoshi Nakamoto started giving it out for free. He gave 10,000 to someone, 50,000 Bitcoins to someone, and nobody cared, frankly. They just said, what is it? How do you start believing in something that you've not seen? I'm talking 2009 and 10. The early adopters were gamers. So, in some network games and gaming system, there are some in-game assets that you win, in-game tokens, collectibles like swords and stuff, which people pay a lot of money for, or they fight to win, etc. So they found Bitcoin cool. They were the early adopters in 2010, 11. Fun fact, might already know this, that somebody paid 10,000 Bitcoins into some gamer who had lots of these Bitcoins, paid 10,000 Bitcoin for 2 pizzas of Papa John's in US in 2010 or so, I believe, which is worth now X million dollars today. So that's how the adoption started. Then in time, in 2000, it then became, so when the gamers started winning it, they started distributing and putting it out in their communities. They started sharing it with their friends. They started buying, selling for services and games and stuff. It got a little bit more spread out than from the original developers. Then in 2014, a guy came around who was around before as well. His young guy, Vitalik Buterin, who started something called Ethereum. So he was saying to the Bitcoin community guys that, why don't you make this money as programmable money? So think of it like in Excel. Bitcoin is in Excel. He said, why don't you put macros in it so you can have conditional payments and conditional stuff? That's what he called smart contract. For example, if in India you take an EMI loan and your loan is RBI's base rate plus minus 1% with some cap and floor of whatever pricing, so it's different payment that will go from your account every month. What if you can program this all at the base of the blockchain itself so that it's a smart contract? Bitcoin guys said, it's too complex, let's not do it. And so he developed something called Ethereum. And he did something very interesting, which is the first time he did something called an ICO, initial coin offering. He was the second guy. Somebody else had done it before him, but for the argument's sake, he was really the first guy who made it work. He asked people to invest in the project of Ethereum so he could go and develop it and hire some people to develop it. He raised, and those people who were interested, who had lots of Bitcoins, gave him like $70 million worth of Bitcoins to go and develop Ethereum as a protocol where you could run these conditional payments and smart contracts, which will do essentially conditional payments or conditional financial transactions based on whatever pre-agreed terms and all. So he developed something called Ethereum. Since then, after 2014, he was successful. He raised lots of money and he invested and built Ethereum protocol and network and everything. Then came about after that flurry of people in 2000, especially in 16 and 17 was a crazy boom period of ICOs, initial coin offerings. Let's say I'm building Flipkart, okay? I'm 2008, it's 2006 or 8, whenever they started. I got the exit in 2018 or 17 when Walmart bought it, right? Which was $20 billion or X, whatever my stake in the company was. But what if everyone got the exit day one? On 2008, when I start, I get like 10 million or 100 million or 1 billion. Will I be incentivized to work as hard for the next 10 years? I won't. So exits came so early, hence all the ICO projects failed. Most of them were shams and scams anyways. That happened. Then in 2000, after 2018 or so, there was a crypto winter. The value had peaked in 2017 to 20,000. The value went down to 3,000 in 2018. Then slowly, then the crypto community keeps coming up with newer ideas. We'll decentralize finance. We'll do securitized token offering, etc. They came up with lots of trends. And the latest one is non-fungible tokens. They keep on talking a lot of stuff, but again, no real value if you ask. If you ask the first principle questions. I will happily share a couple of my blogs where I have to detail these out and explain them, so you can read them in free time if you want to. The evolution has been then last year since COVID. People started moving to more digital assets. Digitization started happening. Shares kept going up due to extra printing of notes. The 5 trillion that came from US and many other countries. Some money found their way into the meme stocks of US, the GameStops, and many others. Then eventually some money went into cryptos. So crypto's value rose from, in March 2020, the Bitcoin value, as an example, was about $8,000, I believe, $8,000 or $9,000, if I'm not wrong. And today, in between, it touched 60,000 early this year, and now it's back to 40,000. It keeps going up and down. Highly manipulatable. Bitcoin has a centralization problem. The centralization is the following. 2% Bitcoin wallets, blockchain wallets, hold 98% of Bitcoins today. How is it different from our capitalistic world today? Secondly, 4 miners in the world, 4 mining companies in the world of Bitcoin are controlling 90% of mining. You still have the same centralization. Those 4 decide something differently tomorrow. Those 4 CEOs get together. Good luck. Thirdly, there are 3 crypto exchanges which control 80% of world's crypto volumes. Now, those exchanges decide something else. There is centralization at every level. There is centralization word in decentralization. There is centralization in Bitcoin and every other coin. There are thousands of other coins. All of them are fairly centralized. They have a CEO. Vitalik for Ethereum and everyone else you can talk about. So these are some of the challenges. Lastly, I'm not repeating the problem of the inefficient energy wastage by just paying for it, just burning so much electricity in validating transactions where you don't need 1 million people validating the same transaction. It's just inefficient process. It's just they achieve like less than a few thousands of transactions every day. No, and for that they are spending millions of servers on it. The humanity is better served if they could make some other progress somewhere else. Last point I want to make: nobody in the world is using Bitcoin as a digital currency, which was developed as a decentralized global digital virtual currency. I don't know. I haven't come across a person who said, I paid my bill using Bitcoin. Everyone says I bought Bitcoin and I sold it higher, or I'm waiting for it to sell higher. 2-3 years ago, spoken to some finance secretaries in central government and explained them the whole concept like I'm explaining you. And I'm not telling them allow it or disallow it. I'm saying that's your decision to make, clearly, but I can just give you the fundamentals, right? And then if you feel it's right, it's right. If you feel it's wrong, it's wrong. I believe they must ban it sooner rather than later. They must control it. But how to do it, how to regulate it, how to control it, there is a lot of detail. And I'm sure forming policy. It's not as simple as it may look from outside, of course. And so in India, of course, if I buy a Bitcoin from WazirX and I go to Canada tomorrow and pay for a Starbucks coffee worth $5, I'm in violation of FEMA Act. I'm clearly violating FEMA Act. If I go and raise money for my startup in a project by claiming it's blockchain backed, then I'd raise money. SEBI doesn't allow crowdfunding. Crowdfunding is illegal in India. You have to go the IPO route, which comes after 3 years of successful track record at least, right? Or whatever the rules are. So people are violating laws without knowing them. So number one, let me just explain what NFT is. So when I say I have a Bitcoin, you have a Bitcoin, it's a fungible one. Means that I have a 500 rupee note, you have a 500 rupee note. It's interchangeable. It's the same thing, right? NFT just means that it's a think of it just like, when you get your UPS document delivered to you, there is a QR code on top of your document or your package. Amazon gives you a tracking ID, order ID, right? Which is unique to every product. Even if I order, let's say, a laptop from Amazon, you order a laptop from Amazon, its tracking ID for both of us will be different, correct? That's all that an NFT is. It's a digital version. They put it on blockchain, and now they've certainly started saying that it's worth a lot. It's worth nothing. It's just a digitization process. Sure, you can have unique stamps. And again, you might say, some people say that, we're going to put it to art. Okay.
Yes.
I had, now what
application right now?
So now let's say I'm an artist. I sign my paintings and I say this is 1 of 10, 2 of 10, 3 of 10, 4 of 10, right? I put 10 paintings out, 1 of 10, 2 of 10, 3 of 10, 10 of 10, right? 10 out of 10. Now you start putting a digital tag on top of it. Sure. They say it's on blockchain, but nobody else is validating. Nobody has capacity to validate. So again, it's a centralization problem that I talked about earlier. But it's a digital tag. Is it valuable? Yeah, okay. It's a tag, right? UPS had it for decades. Amazon has it for decades. How that changes anything or why the value of the art should go up is not understandable to me at all. And by the way, I published a byline on this, which appeared in Mint, where I've explained that NFT is all hype, but no value. And again, it's one of the, I'm against it for the right reasons, and I can send the link to you. But all I'm saying is, if you digitally track anything, you send packages to each other, there's a track, right? There is a track you can apply. Those random tracks have been created now on blockchain, and now they say it's NFT. If my art was worth $1 million for a painting, should it become 10 million because we've applied a digital art to it, at the a digital tracking ID to it? That's all a non-fungible token is. I don't think so. Are you able to track the art better? Yeah, but you were able to do it with UPS and Amazon ID tracking IDs or Zomato order IDs too. There is no difference, except that they claim it's on blockchain that nobody's validating at all. So NFT is one other thing they say. One other use case they say is it's for future digital art. As humans, if you've seen Black Mirror, as humans go into more digital virtual world in the future, consciousness gets uploaded on internet or technologies and many other things happen. Maybe in the digital world, this will be a better way to track. Sure. So I think what you should do is, so one, you can either, as you're saying, if you just want to learn how a blockchain wallet works, how the transfer works, how long it takes, how you buy or sell, how it's just like almost learning how to do trading in capital markets, for example. If you don't buy a stock, you'll not learn what is a Reliance stock or a future or an option or whatever, right? If you want to do just for educational purposes or awareness purposes, do it with 10,000 rupees. You can do it with 5,000 rupees. Indian exchanges exist. WazirX, CoinDCX, I forget the names. There are tons of them. You just Google them online. Go anywhere, open an account, do the eKYC. You learn, you'll understand. And you're right, these are small amounts. It shouldn't matter. You buy them tomorrow, you sell them a day later and see, or withdraw them to your own wallet, do whatever you want to. So you'll learn the process, right? So that there you can do with as small as 5,000 as well, if it's just for educational, or more if you want to bet more. The second potential point is that for, let's say, portfolio investing, let's say you have X amount of money, you want to see if you can make money by doing this, or you can invest a bit more and take the risk. So I think all I would say is put the money you're willing to lose, whether it's 1 lakh or 10 lakh or 1 crore or 1,000 rupees, whatever it is. So this is the riskiest part of your investment, because it's value, as you know.
Yeah, I totally agree with you. Whatever surplus people have to. I'm just saying, from with your depth of knowledge, what you have.
Yeah.
Don't get into what the absolute number or maximum number a person can put. But for you, okay, fine. I think 1 or 2 lakhs, no regulator is going to come after your life. They are not going to make your life miserable. Like, for example, I said 50,000 I can give gift to anyone in India without income tax taxing the donor or the donee.
Yeah.
So what according to you, is it 50 is good, 1 is good, and somebody wants to take a huge risk? That's something different. But from your you look today, if you're investing 50,000, 10 years down the line, either you lose the 50 or this 50 might become 5.
So from that perspective, today you can even go higher than 50 or 1. Even people will, the Indian government or any officials can't, in principle, come after you for investing 10 lakhs or 1 crore. Because what's 50,000 for you, maybe 1 crore for me, or what's 50,000 for you, maybe 5,000 for me. I'm coming down to the point, why do you want to do it? Educational learning purpose, 5,000-10,000 is enough. You want to invest and forget and see, hope it grows. Investing part, it's a riskiest bit. Today, it's not illegal. If tomorrow they make it illegal, then you will have hopefully enough time to liquidate it or sell it out and move out and lose in the process or not, right? Or make money or whatever. So that's on you. But all I tell people is the following. Generally, if you play a game called poker, if you don't know who the fool on the table is, then it's typically you. Okay. So essentially, the game you don't understand, one should not play. That's my view. Right or wrong? Yeah. Right. Now.
No, that's very sensible advice.
Yeah.
Absolutely.
So what I'm saying is, on one part, I'm saying I'm giving you the fundamentals. They don't support the value in Bitcoin. Bitcoin was invented as a digital currency. Nobody's using it as a digital currency. It's highly volatile, highly centralized, highly manipulated. So in this process, it's just like share market to an extent, which is, for some people, it's a casino. For some, it's a organized investing and day job, etc. Right? And what I say is that best thing, if you want to invest, buy or sell periodically, follow the market. You may go with fundamentals on one side, which I've tried to tell you. But if you want to follow the market, there are ways that you see, if it's going up, you keep buying. If it's going down, you keep selling. Follow the market, but don't try to go against the market. Okay, don't bet against the market, because you'll lose a lot. It's the same in stock markets too. So how to follow the market? There are some ways you can learn the momentum of the market. Is it going up? Is it going down? How the sentiment is? There are ways you can analyze all that. But otherwise, for passive investors like you, as lawyers, I'm sure you guys are super busy. You don't have time to check it every day. Even if you put 50,000 or 1 lakh or 10 lakhs, it's not easy to make high returns anymore, because it's a highly crowded game. A lot of people have already come in. It's not likely to go from 40,000 to 100,000 again easily. It might. There is a probability, but it may not. So do some small investing, learn about it, and then forget it. And then as much money as you want to put. But worst case, be prepared to lose it all. That can still happen. Okay. I hope I answered your question. Essentially, the puzzles are the mathematical problems I mentioned, which is essentially eventually coming up with an outcome number, which I try to describe as cryptographically generated hash. That's what miners do after validating the transaction. And then whoever does it first announces the hash to rest of the group. And then they say, yes. You remember the 20 million we had set aside? Initially, Bitcoin in 2010, the blockchain was rewarding 10 Bitcoins or 6 Bitcoins or 25, I forget, there's a number, X amount of Bitcoins to the people who were validating the transactions, who were coming up with this, with the hash first. Not all the community, but the ones who come up with it first. Then that number halves every second, third year. Every few years, it halves. Today, you get 0.5 or 0.25 Bitcoin for validating a block. Okay, it's not just one transaction, it's a block of transactions in which there are a few hundreds to thousands of transactions every few minutes. Okay. Now that the total number of Bitcoin in circulation today is about 18 million. 3 million is still pending. And in principle, fundamentally, will never reach the 21 million, because it keeps halving the mining incentive, the mining of the Bitcoins. The last 3 million, which is still pending, will keep halving every few years. And mathematically, we are unlikely to reach the 21 million number for an amount of time. And I think in between there would be other challenges that will hit us first: regulatory, quantum computing, many other things will come and play a spoilsport, in which case, first case, it can go to zero, right? But I hope I've tried to explain how the mining and the incentive out of that 20 million was being distributed, and is still being distributed to all the miners and validators. So there are 2-3 ways to look at a Bitcoin. One is it could be seen as a digital currency for which it was invented. Second is people call it as a store of value, where gold is like gold is a store of value. You put money in gold and then hoping that it is inflation proof, recession proof, etc. You put money and hope it keeps growing over time. Third is it could be an asset, just like a painting. You are asking an art, which is subjective matter. It's a belief in a system or something. It's a perception value. Bitcoin is actually a mix of everything. It's a mix of a commodity which could be invested into. It's a store of value like gold. People invest in Bitcoin when the markets are down. When people don't trust governments, Bitcoin goes up. Like 2016, Japan legalized it. Donald Trump got elected in US. Brexit happened. Demonetization happened. Bitcoin's value went off the roof. People distrust governments. Bitcoin goes up. So it's a sort of a hedge to the real world as well, a digital hedge or a digital gold as well. So it's a mix of commodity, currency, store of value, investable asset, whatever you want to believe in it. But eventually, it's not as it's slightly different from art, because art is genuinely subjective, and generally there are only a handful of people, and it's not really a mode of transaction as such. But it's a mix of a few things. To everyone on its own, whatever you believe in, you can believe in. So